Welcome to Daily Variety, your daily dose of news and analysis for entertainment industry insiders. It's Thursday, October 30th, 2025. I'm your host, Cynthia Littleton. I am co-editor-in-chief of Variety alongside Ramin Situda. I'm in LA, he's in New York, and Variety has reporters around the world covering the business of entertainment. In today's episode, we'll take a big picture look at what to expect for the industry for the rest of this year and into 2026. We'll talk to Naveen Sarma, Managing Director of S&P Global, who is the sector lead for U.S. media and telecom at the respected data and analytics company. Naveen recently published a report that has some good news and some concerning news for media and entertainment. We'll unpack it all. But before we get to that, here are a few headlines just in this morning that you need to know. The big news in Hollywood is what a great time was had by all at Variety's Power of Women event last night in Beverly Hills. It was really something. The beautiful ballroom was packed with so many insiders. I needed many more hours to do all the schmooze. Our honorees were a wonderful combination of inspiring, funny, gracious, and fierce. And so were the presenters. All of our coverage and copious amounts of video are available right now on Variety.com. And whatever you do, don't skip Sharon Stone's introduction for honoree Sydney Sweeney. It was hot. In other news this morning, and there really is other news this morning, Comcast delivered a less than stellar third quarter earnings report. There's softness in the broadband numbers. The company also appointed a new head of its cable and connectivity division, Steve Croney, who takes over from longtime head Dave Watson. As we expected, Comcast's top leaders, Brian Roberts and Mike Cavanaugh, dodged questions about their interest in joining the bidding war for Warner Brothers Discovery. But Cavanaugh did make a point of noting that the company's ability to secure regulatory approval for a big transaction will improve considerably once the Versant spinoff of the NBC Universal Cable channels is complete. It will be a much smaller company at that point. However, there's still the issue of President Donald Trump's open hostility to Comcast. We'll see if that changes at all after Comcast spins out MSNBC and other cablers into Versant. Meanwhile, Fox delivered a mixed bag of a quarter with higher revenue offset by higher expenses. The bright spot for Fox was Tubi. The ad-supported streamer reached the profitability mark earlier than expected. That's never a bad thing. All of these stories and our analysis and so much more can be found on Variety.com right now. Now we turn to a conversation with an industry leader about news and trends in show business. Today we'll hear from Naveen Sarma, Managing Director and Sector Lead for U.S. Media and Telecom for the respected data and analytics firm S&P Global. Naveen has been a regular on Daily Variety's sibling podcast, Strictly Business, so we're excited to welcome here to Daily Variety today. Here he breaks down the key points that he made in a recent report about the sector trends he's seeing so far in the second half of 2025. Naveen Sarma, Managing Director and Sector Lead of U.S. Media and Telecom for S&P Global. Thank you for joining me today.
Thank you very much for having me.
Well, Naveen, you put out a sector report that was looking at the second half of the year for media and entertainment and what you were seeing shaping up in a year that has been nothing but unpredictable. I thought there was stuff in the report that is going to be nail-biting for Hollywood and stuff that was very encouraging, including your first basic conclusion is that the extremely high demand for content brings stability to this sector, despite all of the disruption that's going on. Fundamentally, people want to be entertained, and that is the demand curve that Hollywood can lean on. In your report, you're talking about film, episodic TV, music, video games, sports leagues, concerts, books, newspapers, magazines, and even consumer-generated content.
Right. So consumers continue to want to consume that kind of content. The problem is there's only 24 hours in the day, and so there's become more fragmentation. The model that made Hollywood work so well and so profitably was you made a piece of content and then you monetized it across what we would call a matrix, right? Multiple geographies and multiple platforms. That hasn't been fixed with the launch of streaming. Yes, their content is being monetized globally, but the multiple platform thing where you put on television, you put it in the theaters, you sold it to multiple media companies. That still hasn't been fixed. And so that's still a problem in terms of being profitable. And in addition, when you look at especially like the large US media companies, while they're growing their profitability on the streaming side, they're still dealing with the overall decline of linear television. And, linear television at one point, in some cases had 40 to 50% margins, and those margins are coming down dramatically. And so that trend still needs to clear where linear television either stabilizes or disappears and streaming profitability takes off before you start to see a reversal and margins start to really improve for the media companies.
There's no conversation about global financial markets would be complete without discussing AI. It still feels like we're in the stage of, boy, there's a lot of promise on the horizon, but what is actually happening now? Are you seeing anybody add a few basis points or add a few percentages to their margin because of AI savings?
Not yet. In our conversations with the companies, the studios, they've talked about the potential to get significant savings, both on the pre-production side as well as on the post-production side. Whether that translates to the studios having greater return on their production, I don't know. Those savings might get rolled up and put back into more productions. So for the money that's saved on a particular movie, it might get put back into additional films, so you might get, an increase in the number of films or TV shows being made, or it may go to paying for talent. So it isn't clear to me yet that these savings are going to show up in the bottom line. But the companies are talking about it, and at some point in the next couple of years, you'll start to see that impact, and they'll probably start to quantify how much savings this means on the bottom line for their content creation.
Another key point you make is about just in general, the much increased focus on profitability for streamers. And you, like many others, very flatly note that Netflix has, quote, an insurmountable lead compared to its industry rivals, end quote. 300 million global subscribers, operating margins of just over 30%. Do you see anybody else getting near that in 5 years?
Not from the legacy media companies. So Disney clearly has taken on that strategy. They aren't necessarily trying to be Netflix, but they certainly have the global scale and the content to be able to, be a strong number two or number three. But you certainly have Amazon who could do that. Apple could do that. The other guys, the legacy media companies, don't have the global scale. Right. And frankly, they're not really pursuing it, whether it's Peacock that is staying primarily in the US and will do joint ventures overseas, or Paramount, which is in many of the English language countries, but hasn't really gone beyond that. And so that limitation itself, the fact that they're not 300 million subscribers in 200 territories, limits their ability to get economies of scale. And so you might see this is where mergers make sense, where you can get scale domestically, but also overseas, where they might be able to try to get to the same profitability levels as a Disney or a Netflix down the road.
Mhm. Do you see Disney Plus as having a lot of runway internationally?
Yes, Disney has an incredibly strong brand, and I know that they're not planning on going to every market, but they certainly could offer their services, whether it's through a joint venture or through them launching their own streaming service in a particular country globally. So yeah, they could, in theory, get to that kind of scale.
Let's move to advertising. You say advertising remains solid after a shaky start to the year. Now, it's a pretty grim forecast for linear TV. National TV, you forecast to be down about 7.4% for the year. That's not a surprise coming off a political year as well as the Olympics last August. Local TV is a little bit better, but also a 3% decline. Digital, of course, no surprise, is you're forecasting 9.5% growth for the year, and for streaming specifically, the number is 20%, 20, up 5.5% from your previous forecast. Naveen, what's going on here?
If you go back to the beginning of the year and the threat of tariffs, advertisers were concerned that tariffs would have a huge impact on the economy. Consumers would cut back on spending. And so there was a pause in March and into April where advertisers basically said, let's take a pause on this and see where the economy is going. And they came back pretty quickly. The one thing about advertising today, especially on digital platforms, is it can get placed very, very quickly. And so the old days where it took months to place, and so it was a trailing indicator of economic activity, that's kind of ended. And so advertisers can turn on and off the spigot relatively quickly. And so they did. And it stayed relatively healthy the rest of the year. But in general, the economy is doing relatively well, especially when you consider how it's comparing to the rest of the world. And advertisers have learned over the years, if you look at the pandemic, if you don't advertise, you lose market share when the economy returns and people start spending. So advertisers have continued to spend, and it's benefited connected TV. And clearly, linear television will continue to lose advertising, but if you're a media company and you sell linear television and connected TV advertising together, in aggregate, that's growing, right? So it's a share shift, but the media companies are benefiting from that because they're getting the streaming advertising as well.
It's an attention economy, and the dollars follow the eyeballs. Your last item is, of course, about M&A, which is also something that has consumed a lot of people at Variety following the bouncing ball of the Paramount Skydance transaction. And now, just as the dust settled there, stirred it up about Paramount possibly going after Warner Brothers Discovery, possibly others jumping in. Barring a different transaction, Warner Brothers Discovery is on track to separate CNN and TNT and a bunch of their well-established declining linear cable channels off into a separate company. NBC Universal is also well along on such a spinoff that they're going to call Versant Media Group. In the harsh light of seeing companies that are divesting, big media companies are divesting these assets, I'd have to ask the skeptical question, what is going to be the reception to these? Are they going to be seen as a well-built but listing ocean liner?
That's a good question. I'm not an equity analyst, so I can't talk about how the equity is going to perform. But from a credit standpoint, the question we're getting asked by investors is how long are these businesses going to last? Is it 10 years? Is it 5 years? Is it 12 years? It's, to make a comparison, it's kind of like yellow pages in newspapers, right? It's a decline. Can they manage that decline and that decline in the cash flow? What creditors want to know is, can they get repaid? You're not going to see these companies go out and do 10-year or 15-year bonds, because who knows what the world is going to look like in 10 or 15 years. They're going to be shorter duration and probably more focused on bank debt, which will amortize and they can pay that off quickly, right? They can pay it off as they're generating cash flow. So as long as they're generating cash flow, as you can continue to finance these businesses, but as EBITDA declines, the amount of debt that public shareholders, private bondholders, private debt holders are willing to put into this company will continue to shrink. And the question is, how long will that go on? Yellow pages companies are still around, and or newspaper companies are still around. And so it doesn't just dive off a cliff. It takes time. And so the question is, how long is that going to take?
At some point, it just becomes math. Let me button up by asking you, Naveen, how is what's going on in the credit marketplace and with interest rates, how is that impacting the level of M&A going on in media and telecom? You think, would there be more activity if things felt a little more stable?
Interest rates are interesting because treasury rates are high today versus where they were 5 years ago. So the spread between the treasuries and where corporate debt trades are at historic lows. The challenge for a lot of these companies and the big investment grade companies have less need for financing unless they're doing M&A. And so, they benefit from that. But if you look at a lot of the smaller companies who are going through refinancings, there's a lot of questions about long-term viability of some of these sectors, especially legacy media. And so the interest rates that they have to pay to refinance debt is staggering. It's 9%, it's 10%. My parents would say that, these were rates that they saw back in the 70s.
Right. And that right on its face is just prohibitive. You can't do it.
Right.
Naveen, thank you so much. You're in the thick of media earnings season. I really appreciate you taking this time out to talk with us.
You're very welcome.
As we close out today's episode, here's a few things we're watching for. Here comes Stranger Things. The season 5 trailer is out and it looks spooky good. The first 4 episodes drop on Netflix on November 26th, but you already know that because you read about it earlier this month in Variety's cover story with the Duffer Brothers. Here comes the American film market. The annual film market is back to Los Angeles after shifting to Las Vegas last year. Nobody liked the vibe in Sin City, so they're posting up at the Century Plaza Hotel this time around. Somehow I feel like the AFM is just going to continue to keep moving west, and in a few years it'll probably be back in Santa Monica, where it was held for decades. Starting tomorrow, we'll produce the first of 2 digital dailies out of the Lava documentary film festival in the Czech Republic, and next week we'll be in Taiwan covering the Taiwan Creative Content Fest. You can find all of that coverage on Variety.com under the Global tab. Before we go, happy birthday greetings going out to Variety's Michelle Sobrino Stearns. We can't wait to see what the coming year brings for our fearless leader as she segues into a new chapter of her career. Rock on, MSS. Thanks for listening. This episode was written and reported by me, Cynthia Littleton. Stick, Snicks, Hick, Picks. Please leave us a review at the podcast platform of your choice, and please tune in Monday for another episode of Daily Variety. And once again, for all the marbles, go Dodgers.